What if one of America's most trusted allies, a country that shares intelligence with Washington, hosts U.S. military bases, and has stood beside America for decades, quietly began moving its money toward Beijing, not gradually, not cautiously, but at a speed that left the International Monetary Fund searching for words to describe it? That is not a hypothetical scenario. That is happening right now. And honestly, most of the world hasn't fully processed what it means yet. Act 1. The deal that started everything. Let's begin with a single transaction. Because, the biggest turning points in history rarely announce themselves with fanfare. They arrive quietly, buried in financial filings and press releases that most people scroll past without a second thought. In August 2025, an Australian mining giant named Fortescue, one of the world's largest iron ore exporters, walked away from US-based funding channels entirely. It sat down instead with two of China's most powerful state-owned banks, the Bank of China and the Industrial and Commercial Bank of China. When those meetings concluded, Fortescue had secured a syndicated loan worth 14.2 billion Chinese yuan, just under $2 billion US dollars. On the surface, that might sound routine. Companies borrow money all the time, but dig one layer deeper and the details become remarkable. The interest rate on that loan was 3.88%. Around the same period, Bloomberg was reporting that Australia's 5-year government bond yield, the rate at which the Australian government itself borrows, sat at approximately 3.67%. The gap between those two figures is barely a quarter of a percentage point. Here is why that matters. Governments borrow at the lowest rates in any economy because they are backed by the full power of the state. Taxation, monetary policy, and the practical impossibility of default. Corporations pay more because the risk is fundamentally different. Lenders need to be compensated for the possibility that a business might fail. Yet Chinese state lenders extended terms to Fortescue that were almost indistinguishable from what a sovereign government would receive. Fortescue confirmed it openly, announcing it had secured the lowest cost of borrowing in its entire corporate history. Not from Wall Street, not from London or Tokyo, from Beijing, denominated entirely in Chinese yuan. Reuters called it the largest instance of an Australian company raising debt directly in Chinese currency. The IMF flagged it immediately, and Washington quietly took note, with a diplomatic restraint that barely concealed the underlying alarm. Act 2. This didn't happen by accident. Seismic financial shifts rarely emerge from a single decision. They're almost always the result of accumulated frustrations, quiet strategic recalculations, and smaller pivots that eventually reach a tipping point. Earlier in 2025, Fortescue was still deeply invested, literally, in the United States. The company had committed approximately $550 million to a hydrogen energy project in Arizona. It was ambitious, forward-looking, and aligned with the global clean energy transition. But as the year progressed, U.S. regulatory conditions became increasingly unstable. Policy signals around clean energy investment shifted. Incentive frameworks that companies had built entire business cases around began to look uncertain. By mid-year, the Arizona project was dead. Fortescue took a $150 million write-down, a painful accounting of what regulatory unpredictability in America had cost them. The Wall Street Journal framed the withdrawal as part of a broader pattern of investor discomfort surrounding U.S. clean energy policy. With $500 million of planned American investment now abandoned, Fortescue looked elsewhere, and the destination was obvious. China already purchased more than 80% of Fortescue's total iron ore exports, according to Australian industry data from mid-2025. The commercial relationship between the two wasn't peripheral. It was the backbone of the company's entire revenue model. From a pure financial logic standpoint, the yuan loan made elegant sense even before you consider the favorable interest rate. When your primary customer pays you in a particular currency, and you can simultaneously borrow in that same currency, you eliminate a significant layer of foreign exchange risk. Your revenues and your debt obligations are aligned. The currency volatility that quietly destroys profit margins in international business becomes far less dangerous. Fortescue wasn't choosing Beijing over Washington out of sentiment, it was following the numbers, and the numbers told a clear story. Act 3. The government follows. What happened next elevated this from a significant corporate transaction into something far more consequential. Because within days of Fortescue's yuan loan making headlines, the Australian government itself began moving in the same direction. Australia's Treasury issued its first bond denominated in Chinese yuan. Government bond issuance is one of the most symbolically loaded acts any national treasury can undertake. The choice of currency for sovereign debt is not an operational footnote. It is a declaration about where a country sees its financial future. And Australia's Treasury had just made that declaration in unmistakable terms. But the development carrying the greatest long-term weight came from the Reserve Bank of Australia. The central bank revealed it had dramatically increased its yuan holdings, bringing Chinese currency to represent approximately 25% of Australia's total foreign exchange reserves. 1 year earlier, that figure had been just 5%. A shift from 5% to 25% in 12 months is not conventional diversification. It is a fundamental restructuring of national financial priorities. The IMF responded with language that, for a typically measured institution, bordered on astonishment. Officials described the development as extraordinary, specifically noting that no advanced economy had repositioned itself toward China's currency with such speed. Across the Asia-Pacific region, central banks had been gradually increasing yuan exposure, with IMF data showing year-over-year growth averaging around 40%. That was already notable. But Australia's pace was an outlier even against that elevated regional trend. Other countries were jogging in a new direction. Australia had broken into a full sprint. Act 4. Building the infrastructure. Transformations of this scale don't simply happen because executives decide to borrow differently. They require, institutional architecture, the regulatory frameworks, banking systems, and legal structures that allow new financial arrangements to function at scale. Australia spent much of 2025 quietly constructing exactly that infrastructure. In August, Reuters reported that Australian financial regulators had updated rules to facilitate syndicated yuan lending within Sydney's banking system, formally embedding Chinese currency operations into the heart of Australia's primary financial center. ANZ, one of Australia's largest banks, introduced dedicated yuan clearing services for corporate clients, enabling direct transactions in Chinese currency without routing payments through dollar-dominated correspondent banking networks. The People's Bank of China reinforced the shift by offering discounted settlement fees for yuan transactions, making them meaningfully cheaper than equivalent dollar transfers. For corporate treasury departments where basis points accumulate into real money across hundreds of transactions annually, these cost differentials matter enormously. The data reflected the institutional changes in real time. According to the Australian Bureau of Statistics, by September 2025, approximately 14% of Australian exports to China were invoiced in yuan. 1 year earlier, that figure was 3%. Nearly a five-fold increase in 12 months. Australia's primary stock exchange confirmed plans to accommodate yuan-denominated bond listings, enabling companies to access Chinese liquidity pools directly, bypassing the dollar-denominated capital markets that have served as the default gateway to international funding for decades. Federal budget disclosures confirmed that yuan-denominated borrowing had generated debt servicing savings measured in hundreds of millions of Australian dollars within a single year. These are not projections. They are realized fiscal outcomes, money that translates directly into reduced pressure on public finances and powerful political vindication for the officials who authorized the shift. Australia's sovereign wealth fund, managing over 250 billion Australian dollars, signaled it could allocate as much as 1/10 of its entire portfolio to yuan-denominated assets. A major Australian retirement fund launched an investment vehicle structured in yuan supporting infrastructure projects across the Asia-Pacific. When pension funds managing the retirement savings of millions of ordinary Australians begin channeling capital through yuan-denominated vehicles, the shift ceases to be a story about boardrooms and government treasuries. It becomes embedded in the financial lives of everyday people. Act 5. What Washington saw. The United States watched all of this with a combination of genuine concern and carefully calibrated diplomatic restraint. The Financial Times reported on a diplomatic cable indicating that U.S. officials were actively monitoring yuan bond activity in Sydney and not treating it as routine portfolio management by an ally. They were tracking it strategically, analyzing it through a lens that extended well beyond reserve allocation percentages into the realm of alliance architecture. The Lowy Institute, one of Australia's most respected foreign policy research organizations, published a policy brief cautioning that Australia's reserve diversification could complicate its relationship with the U.S. Federal Reserve. During periods of global financial crisis, access to Fed dollar swap lines has served as a critical safety mechanism for close American allies. The implicit warning was significant. Deep financial repositioning toward Beijing could eventually prompt Washington to reconsider the automatic nature of that backstop. Australian officials responded by framing the strategy consistently as prudent diversification. Sensible risk management appropriate for a sophisticated economy navigating a multipolar world. They drew careful distinctions between financial diversification and geopolitical realignment, insisting the two were not equivalent. But the distinction grows harder to sustain as the numbers grow larger and the institutional changes grow deeper. When your central bank holds 25% of reserves in a rival superpower's currency, when your sovereign wealth fund is considering 10% allocation in that same currency, when your stock exchange enables direct yuan listings, and when your major corporations secure their cheapest ever loans from Chinese state banks. At what point does diversification become something more fundamental? That question doesn't have a clean answer, but it is the question that policymakers in Canberra, Washington, and Beijing are all sitting with right now. Act 6. The dollar's architecture and its vulnerability. To understand why this matters beyond Australian financial policy, it helps really to step back and examine what dollar dominance actually is and how it functions. The U.S. dollar has served as the world's primary reserve currency since the Bretton Woods Agreement of 1944. That status has given America what French economist Valéry Giscard d'Estaing memorably called an exorbitant privilege: the ability to borrow at lower rates than any other country, to trade internationally without bearing currency conversion costs, and to exercise extraordinary leverage over global financial systems through control of institutions like the Federal Reserve. Dollar dominance is built into the plumbing of global commerce. Most international commodity contracts, including oil, natural gas, and iron ore, are priced in dollars. The SWIFT financial messaging system operates in a dollar-centric framework. Most trade finance is denominated in dollars. And for decades, even transactions between countries that have nothing to do with America have been conducted in dollars simply because it was the most liquid and universally accepted medium of exchange. This architecture is, you could say, self-reinforcing. Countries need dollars for international trade. To get those dollars, their central banks hold dollar reserves. Those reserves are invested in U.S. Treasury bonds. That investment keeps American borrowing costs lower than they would otherwise be. Cheaper American borrowing funds, American economic and military power, which in turn underwrites the stability that allows international trade to function in the first place. It is a circular system that has been remarkably stable for 80 years. But circular systems have one fundamental vulnerability. They depend on continuous participation. If enough significant actors find alternative arrangements genuinely more attractive, if yuan financing offers better terms, if clearing systems outside SWIFT become efficient enough, if transaction cost savings are real and accumulating, the incentive to maintain dollar-based arrangements starts to erode. That erosion doesn't need to be sudden or dramatic to be consequential. A shift from 60% to 50% dollar reserves among global central banks, spread across a decade, would represent trillions of dollars in reduced demand for U.S. Treasury bonds. That would push American borrowing costs higher, putting pressure on federal budgets, corporate financing, and the interest rate environment that American consumers live with every day. The effects would ripple from abstract central bank decisions into the very concrete realities of mortgage rates and public services. Australia's repositioning is one data point in that larger story. But it is an unusually significant and unusually loud one. Act 7. The speed of change. Perhaps the most striking aspect of everything in this story is not what happened, but how fast. Within approximately 12 months, the share of Australian exports to China invoiced in yuan grew from 3% to 14%. The RBA's yuan reserve holdings grew from 5% to 25% of total foreign exchange reserves. Fortescue completed the largest ever yuan-denominated borrowing by an Australian company. Australia's Treasury issued its first sovereign yuan bond. Regulators updated banking rules to formally embed yuan clearing within Sydney's financial system. A major retirement fund launched a yuan-denominated investment vehicle. None of these events unfolded over a decade of gradual institutional evolution. They happened within a single calendar year. The IMF projected that if current trends continued, Australia could find itself among the most currency-diversified advanced economies in the world within a relatively short additional time frame. The comparison point analysts kept reaching for was the post-World War II transition from British pound sterling to US dollar dominance. A shift that took the better part of 2 decades to fully materialize even under extraordinary circumstances. What is unfolding in Australia suggests that transitions in the contemporary financial system can move far faster than historical precedent would predict. Digital infrastructure, modern clearing systems, and the sophistication of current financial markets compress the timeline within which new arrangements achieve critical mass. The demonstration effect matters enormously here. Other countries, including some publicly committed to dollar-centric arrangements, are watching Australia's experience closely. The interest rates Fortescue secured, the reserve savings the RBA is generating, the debt servicing reductions in the federal budget. These are concrete, quantifiable outcomes that finance ministers and central bank governors elsewhere are analyzing and discussing. If Australia achieves these outcomes without severe consequences to its alliance relationships, others will draw conclusions from that experience. Closing. A world between currencies. Step back from the basis points and percentage allocations and consider what this story actually represents at its most fundamental level. For nearly 80 years, the architecture of global finance has rested on a foundation built in America. Countries around the world, including America's closest allies, have operated within that architecture not primarily because they were compelled to, but because the dollar's depth, stability, and universal acceptance made it the rational default choice. What 2025 in Australia reveals is that this rational default is beginning to be questioned by actors, corporations, pension funds, central banks, and government treasuries, who have run the numbers and found an alternative that works better for them in specific and concrete ways. Fortescue found cheaper financing in yuan. The Reserve Bank found reserve diversification benefits. The Federal Treasury found debt servicing savings. Exporters found reduced transaction costs. Pension funds found investment vehicles aligned with where their trade flows actually go. These are not ideological choices. They are financial decisions made by institutions whose entire purpose is to optimize outcomes. And financial optimization, pursued consistently by enough actors across enough contexts, reshapes the world. The question that 2025 has posed, and that the years ahead will answer, is whether the United States can offer a compelling enough counter-argument. Not a political argument, not a security argument, a financial argument. One that makes the dollar competitive in the precise terms that Fortescue, the RBA, and Australian pension funds are using to make their decisions. If it cannot, then what began with a mining company's loan in August of 2025 may eventually be remembered as something far larger than a corporate financing transaction. It may be remembered as the moment when one of America's most trusted allies began quietly building a financial future that Washington was no longer automatically at the center of. The world isn't ending, but it is being rearranged. And rearrangements that begin at the level of reserve currencies and sovereign bond issuances have a way of eventually touching everything: trade, security, diplomacy, and the daily financial lives of ordinary people on every continent. The only real question remaining is not whether this shift continues. The trajectory, for now, is firmly established. The question is how quickly the rest of the world decides to follow. If this video made you see global finance differently, if it showed you that the architecture of the world's money is more contested and more fragile than the headlines suggest, then you already understand why this story matters. Hit subscribe if you want analysis that goes beyond the news cycle and actually explains the forces reshaping our world. Share this with someone who needs to understand what's happening behind the surface of global markets. Because the shift from a dollar-centered world to something more complicated is not a future prediction. It's a present reality. And the people who understand it early will be far better positioned for what comes next. Stay sharp. Stay informed. We'll see you in the next one.